Hello and welcome to a brand new episode of ETMarkets Smart Talk, a show where we engage with top experts to provide complete insights into current market trends and their impact on stocks and sectors. Well, my name is Shatash Anand, and today we have with us a very special guest, Kumaar Bagrodia, who's applied neuroscientist and founder NeuroLeap. Now, NeuroLeap is a leading applied neuroscience company leveraging brain-computer interface technology for better mental health and brain enhancement. In fact, over 20,000 people have taken the deep neurotech based NeuroLeap brain function assessment, which places sensors all over the head and read brain waves. Well, from cognitive biases and emotional investing to building mental resilience in volatile markets, well, this conversation explores the intersection of neuroscience and investing. A must watch for investors, traders, and fund managers seeking a psychological edge. Well, welcome to the show, Kumar.
Thank you, Kshitij, for inviting me.
Thank you so much for taking the time out. Well, Kumar, tell me something. How do you reconcile the assumption of efficient market hypothesis with the emotional and often irrational behavior of real world investors?
Great question, Kshitij. Neuroscience actually is at the core of all investor behavior. Investor behavior is not simply a matter of logic or rational decision making. Instead, it is actually largely driven by subconscious neural activity and very conditioned emotional responses. And I'll tell you a little bit in terms of the research. So, there are several studies at the outset which have proven that up to 95 to 99% of human behavior in terms of decision making is actually
Okay.
governed by subconscious brain patterns, which means that most investor reactions of buying, selling have already occurred before they consciously reasoned and they made a decision. So these subconscious drivers include the emotional memory from the past. What are some of the markers in the present? What are some of the deeply wired survival responses? And if you compare that with the efficient all markets reflect available information and are therefore rational. But if you look at it from a neuroscience and behavioral finance perspective, there's compelling evidence that investor decisions are far from purely logical. So it's largely about three or four major networks in the brain, which are sort of pulling and tugging at each other to arrive at certain decisions. So the first one I would go to is called the default mode network, which gets activated when investors are simulating a future loss or a future profit or are replaying the past market failures that they've had. So it's kind of generating an anticipatory anxiety or an anticipatory regret, right? Alongside, there's a second network called the salience network, which amplifies all the emotionally charged news or the price swings that you are seeing, right? So it often is responsible for triggering the panic or the herd mentality. And when the
True.
markets are volatile, that's when the central executive network, a third one, is responsible for staying calm, for analyzing the situation, but that can be easily overridden by the emotional reactivity system, which basically is taking our primal instincts of fear or greed to the fore, right? So it can override all of these rational systems.
Yep.
But I think on another hand, when you talk about efficient market hypotheses, we all know every moment they're inefficiently efficient, which means over a medium or long term, the anomalies will get corrected. But in every moment, there's inefficiency built in. And that inefficiency is being driven by the en masse neuroeconomics of individual brains who are the players in the market, right? So this aligns actually very well if you see
Mm.
with various studies which are talking about patterns which are exhibited in the major bubbles and the major crashes that we have seen. As you would know, and I'm sure you will agree, that most bubbles and crashes are, being already called out by certain rational individuals, right? And you'll see it on television, you'll see it, in editorial pieces where people are bewildered, that why are markets going in a certain direction, unbridled, whether it is going
Mm.
up or going down. But it is only after a certain amount of time when that frenzy, whether a buying frenzy or a selling frenzy, has ridden its course, markets correct themselves, right, in either direction. So
In
there's
either
a lot of
direction.
bias which is built. So in summary, I'd say to this question is that the efficient market hypothesis is a very idealized model. So
Right.
markets are not efficient because investors are not emotion-free algorithms, right? I think it's a different matter that going forward there'll be maybe more algorithmic trading, maybe more
Mm.
AI-based trading, which will mean that we are
Right.
not as emotional in our buy or sell decisions. But let's understand very clearly that markets are being operated by emotional organisms. There is a
Right.
person who is looking into the data and making a certain decision. That decision is being impacted by several
Mm.
subconscious brain patterns. It's impacted by our upbringing. It's impacted by the kind of experiences we have seen in the last 5, 10, 15, 20 years. So,
Right.
you missed a certain bull run. Now you don't want to miss it again. So there's FOMO. You've
Mm.
had a major loss in the past. You don't want to go through that experience again. So you become risk averse, so on and
Right.
so forth.
Absolutely. Now, in fact, I'm sure our viewers would sort of understand that there are multiple emotions that are going on, in the brain when they are making the buy or sell kind of a decision, or when they are stuck in a particular situation, whenever they are trading or whenever they are investing. But let me also connect with another question there, Kumar. And in fact, you've touched upon that particular question, but let me also quickly take it through to you. Is there's definitely a big debate. Can markets ever be truly efficient when the majority of participants are driven by subconscious biases, which you really talked about? How and when the crashes happen, or whenever the market is moving in either directions. So, what is your view on that?
So, I would say that, whilst it's clear that markets are in a way aggregating the various emotional instincts as much
Sure.
as rational calculations, right? So,
Hmm.
one perspective to think about is that it also depends on the rationality or emotional behavior of some of the larger market participants, right? So, for example, when there are big movements upwards or downwards, the next
True.
day, news will report that certain buyers or certain sellers who are big movers were either
Yeah.
spooked or were excited by something, right? So one of the things then to realize is that what is really going on in the brain patterns of these large market players, and sort of the wisdom of the crowd, right? So the wisdom of the crowd is not really their knowledge. It's not really their rationality in the immediate sense. Yes, they will behave rationally over a longer period of time, but at times of big movements or at times of big phases of bull runs or bear phases, what's really happening to
Yeah.
that rationality? So I would at best call it it's a bounded rationality, not a full efficiency, because most of these participants are being shaped by their history, by the social context, and I would even go to the extent of saying they are being shaped by the neurobiological states, right? So, for
Exactly.
example, if let's say an entire group of investors who are usually considered bullish, right, or a community or a certain group which is always bullish, now suddenly they're not feeling too well for whatever reason, right? they're all facing high amounts of anxiety at work or at home, or they are not feeling fit enough, or they've all been affected with seasonal affective disorder, right? Over a particular monsoon or a particular winter season. What could really happen then, right? Because their decisions are being impacted by their neurobiological state as well. So, it has been shown that we use mental shortcuts called heuristics, right, to make decisions. And these shortcuts are actually very evolutionary, they're adaptive, and they're often inaccurate, right? So let's take a very real example. So, there's something called as the availability bias, right?
Okay.
So this makes people judge the probability based on what's most recent or vivid in memory. So if
Okay.
a trader sees a headline of a, let's say, a tech collapse, right, a technology-based collapse which is happening, they may actually withdraw from unrelated sectors due to this bias, because it is being driven by certain networks in the brain which are now painting the entire color, uh, black or gray, right? So it requires a different level of training not to do that, right? Or for example, there's a framing bias, so on and so forth. So there are several sort of hypotheses which have actually played out over and over again. There's this really interesting thing called risk as feelings, right?
Okay.
Risk as feelings. So where you're measuring risk on the basis of your feelings, right?
Okay.
And it's a proven theory on how people have actually used their emotional states unknowingly to be the dominant factor in their investment decisions.
Exactly. In fact, a very nice point there, Kumar, that when you what you're feeling, and that is what is leading you to make that decision. And yes, at times it does go the either way. But you were talking about the biases. One was the availability bias. One was the framing bias. What are the common cognitive biases that investors should be most aware of during volatile market conditions?
So there are several biases, if you see, which have actually now been very well documented. And
Okay.
on one hand, one could say that a lot of these biases are psychological, but it's far from that. Several of these biases have actually existed, way before psychology started understanding them. These are more
Okay.
primal in nature, right? And a lot of these, if you will see, have come through years and years and decades of conditioning of the human brain. So one is the conformatory bias, where you want to conform to what everyone else you think is actually working on, right? So which also leads to investors making decision in hordes or groups.
Right.
It
Right.
could be the social circle they interact with usually. It could be the friends they are in touch with. It could be the kind of media that they are consuming on a regular basis. And they identify, with those characters and with those sort of emotional states. A second and very common bias is FOMO. So where again, based on the fear of missing out, where you believe that this is not something which is correct, whether to buy or sell, but everyone around you is been sharing experiences of how good their results have been because they sold or because they have been continuously buying, and then you will make a decision just out of the fact that you don't want to miss out, right?
Exactly.
Similarly, we find that people will many times start looking at price comparisons, right? And you'll see why several stocks, once they've gone through a split, suddenly start increasing in pricing because the perceived value in the brain,
Right.
when you compare it to other stocks in the similar space or sector or market cap or any other grouping,
Yeah.
appear to be somewhat more reasonable or cheaper, right? So,
Exactly.
so there's
Exactly.
a comparison bias where you're not really going after the rational understanding of that particular
Right.
stock or sector. It's more just
Mm.
a comparison. It could be on the example I mentioned, or it could just be where you look at a stock in a particular sector which is not as grossly overpriced as the others. Doesn't mean
Mm.
this one is not overpriced enough, but
Mm.
at a sectoral level, it still is cheaper. So a
Choosing
comparison
the lesser
bias is
devil.
that, yeah, it's a lesser devil. You hit the nail on
Yeah.
the head, right? And several of these can keep investors
Yeah.
away from the real rationality, right? And that becomes a challenge because then you're not understanding, is this decision based on a preconceived notion that I have? The bias could be towards risk taking,
Mm.
because in certain instances when you took similar risks it didn't play out, so now
Yeah.
you're becoming risk averse, although this time rationally the data is pointing in a different direction. But
Sure.
because of the pattern created in your brain, you've now got a bias against risk, not towards risk seeking behavior. So I could go on and on. There are just so
No,
many of these.
absolutely. I know. I'm sure investors and traders would relate to this whenever they are in that situation. They would identify with the kind of biases which you've listed out and how they kind of act and how they kind of not help, but move the investors into taking the decision which probably they are taking. Let me also get your viewpoint. So how does neuroscience explain the emotional highs and the lows that investors sort of experience during the market cycles?
Sorry, I lost you there for a bit.
Okay, okay. No, I was just saying that how does neuroscience explain the emotional highs and the lows that investors sort of experience during the market cycles?
Right. So again, it is largely driven by subconscious patterns and
Hmm.
networks. When
Okay.
markets are behaving with a lot of exuberance, there are networks in the
Hmm.
brain which start predicting a certain reward even before it has been accrued. So the
Right.
brain starts assuming that this decision is actually going to give a person a huge amount of returns or money, right? And that leads them to behave in a very irrational manner because the assumption is that this reward is definitely just coming through, right?
Right.
The flip side is also true, that when markets are really going through a bad time, or there's extensive selling pressure based on fear, a
Mm-hmm.
different network which is on anxiety, on self-preservation starts kicking in.
Right.
And the brain is unable to distinguish that decision, whether it is just going with that negative flow or whether it is actually going in with a certain stable understanding, right?
Okay.
So it could be, like I said, you could be herding in that moment. It's like a social contagion effect. So
Okay.
those reward circuits or those social
Mm.
cognition networks are
Right.
causing people to follow that group behavior in that wave, whether that wave is
Right.
positive or negative, right? So it
Mm.
shows that others' decisions actually activates your own reward related areas. So
Right.
you become almost neurologically, you find it rewarding to
Yeah.
conform to what everyone else is doing, right? So when
Exactly.
these big
Exactly.
movements are happening, yeah.
Mm.
You don't
Mm.
know whether you're acting because you want to just find safety in the fact that I'm doing something that everyone else around me is doing, right?
Mm.
And because the brain at a certain level doesn't have enough information to
Okay.
cut through the clutter of the noise in that moment, right? It doesn't have enough capability to
Mm.
absorb everything, process it rationally. So it finds it easier to say, you know what, I'll just go with what everyone else around me is doing, right? And
Ah,
that's
okay.
one of the very prevalent biases.
Right.
And this is one of the key biases which forms your one-sided movements, where an
Sure.
entire chunk of the market is behaving in a certain manner.
Absolutely. Can investors rewire their brain, Kumar?
Yes, of course. And when you say rewire the brain, it is really about a two-step process. The
Okay.
first one is that investors need to understand what is their subconscious brain pattern, right?
Mhm.
And we use technology to do that, so that we
Mhm.
eliminate any psychological biases, any subjectivity out of this
Mm.
process. And so what this involves is having your brain mapped, which is
Okay.
placing sensors all over your head, and
Ah.
without asking you any single question, there's no psychiatrist involved, there's no psychometric test involved. We're simply reading your brain waves for about
Right.
20 to 30 minutes. And we are taking in depth data points about your subconscious brain patterns, including
Mm.
all the patterns that I have been mentioning in the last 10 minutes or so, and more.
Right.
We are able to
Mm.
actually understand why you are the way you are, what makes you you. So people might be self-aware that, oh, they operate out of anxiety, but they need to know why they operate out of anxiety, or why do they operate out
Mm.
of greed, and what is it in their brain specifically which makes them behave in that manner. So
Ah.
we are able
Right.
to do that very objectively. And
Okay.
then through a series of sessions, we can actually allow them to, as you said, rewire their brain
Right.
patterns.
Well, absolutely. Well, I'm sure our traders would take note of that. And finally, let me also quickly get your viewpoint on the much talked about topic, which is the AI, and it's the AI making. You could say that. So, how can leaders and sort of fund managers build a more emotionally resilient mindset when navigating uncertain markets?
Very interesting questions. I wish AI could completely make us absolutely resilient, but I think there are two parts to it. So one, um, I have seen now people using AI to sort of coach their own responses better, right? So if you can use AI as a learning tool to talk about your own patterns, to talk about your own behavior and actions in the past, and feed it enough data so that AI can actually tell you, what you're doing correct or wrong.
Right.
But I believe that's just the tip of the surface, because
Mm.
that doesn't mean you'll be able to change your behavior, because changing one's decision making is very, very difficult.
Mm.
It requires strengthening of several aspects when it comes to brain and neuroscience in terms of brain function. One is self regulation. So, what is
Okay.
self regulation? Self regulation is the ability to do things which are good for your long term interest,
Mm.
although in the short term, it might not be giving you pleasure.
All right.
And self regulation is one of the important facets of decision making.
Mm.
The second one I would say is interoception. And very
Okay.
simply put, interoception is having deep awareness of your internal state, your mind
Okay.
body connect, your brain body connect. So many times we'll say, oh, I have a gut feeling, right?
Gut feel. Yes, right.
Which is fine. As long as you have enough data and you have jotted down each time your so-called gut feeling made you buy or
Mm,
sell or do things in a certain manner, it can negate, or it can make you do certain things which might go with your gut but might not
mm,
be rational, and might not be the correct thing. So you need to be able to be aware that how has your
mm.
gut served you, right? And the third one, then, I would say, is, at a neuroscience level, is to look at your brain and your networks as a whole, and
Mm,
also individually, to understand that in a moment of crisis, or in a moment of euphoria, or in a moment
mm,
where there's just bad news all around or euphoric news all around, how will your brain respond? And having
exactly.
that
Mm,
objective insight, having that objective knowledge is
mm,
profoundly important, because it could be the difference
mm,
between really bad decisions and good decisions, right? So AI, I think, is great. It can actually help you
mm.
understand yourself better. But better than AI is having objective neuroscientific data.
Absolutely. Well, objective neuroscientific data is something which traders can make use of for their profitable trading and investment journey for wealth creation. Well, on that note, thank you so much for your time, Kumar. And that's all for now. But do stay low on to ET Markets live stream more on investment and trading ideas. Again, thank you so much for your time, Kumar.
Thank you, Shatish.